to Stock Charts Trading. Today, let's talk about the dreaded thought of being assigned the stock shares. In a bear call credit spread, it consists of one short call. That means you're selling the right to somebody, the ability to buy a call from you. Since you're selling it, that's where the net credit comes in, the amount received. But what you're selling them is the right to buy XYM at $100 from you. They're giving you $3.30 to buy that right from you. You don't own the shares, so what you do is buy from somebody else the 105 calls as protection, and that costs you $1.50, and you're keeping $1.80 for putting all this together. So the person that bought the stock option from you can exercise that position any business day. Holders of the short stock option position have no control over when they will be required to fulfill that obligation. Therefore, an early assignment is a real risk, and we need to consider that. The long calls that we purchased for protection have no risk of early assignment because we own those. Now, what are some reasons for early assignment are usually related around dividends. The short calls that we sold will be assigned generally the day before the dividend date, which is around 2 days. In Sell the News, we're looking for price to come up into resistance, and we're going to sell the call that's closest to the current stock price. Then we will buy back a higher strike price call for protection in case price goes up. We do not have unlimited risk. We keep this dividend alert on our charts. So even though we like this trade up against resistance, because the dividend is just a couple days away, we're going to wait. That way you remove the risk of being assigned. If you're already in the trade coming up to dividends, keep this in mind. If the stock price is above the strike price of the short call in a bear call spread, the lower strike price that we sold, that gives it a higher probability of being executed. So if we sold down here at the 135s and bought the 138s for protection, now price is higher than that, it'd be a good chance that they'll execute the assignment of these lower calls that we sold. Versus if you sold up here and price fell off, it would cost them more money to buy this higher strike price. It would just be better for them ROI to find something that is lower in the money, giving them a better ROI. You can eliminate this risk in two different ways. Close the entire spread, which involves buying the short to close and selling the long to close. The other alternative is to close the short call by purchasing it back and keeping the long calls open, because remember, you bought those. These are paid for calls for you. So if you think you're coming into earnings or something like that, where price might go exponentially higher instead of going down now, you could just close out half the trade. If assignment does occur, then you're obligated to deliver the shares of stock to the person you sold the calls to. You can do that from buying it in the marketplace or by executing your long calls, the 105s, giving you the stock price at 105 so you can trade the shares in. This will need to take place within 1 day of the stock sale, or there could be additional fees, including interest charges and commissions. Now here's a big one, but don't worry. Assignment of the short calls might also trigger a margin call if there's not sufficient funds in the account. In our example, we're looking at the $100 strike price, and this is equated to 100 shares. 100 shares times $100 equals $10,000. So yes, you'll have to have $10,000 in order for your account to be balanced or on margin. Kind of like DRNA. I had 10 contracts, so they gave me 1,000 shares. The strike price that I sold the calls were $35. So now it's $35,000. But if you notice, I'm still looking at this going down because these shares are shorting the current stock. These are not long stock prices, but shorting stock prices. So with a bear call spread, that means when you're assigned, you're also giving the assignment in short shares. That's why you have to sell your calls and buy shares, because this side of the position doesn't help you. Even if you close it out right now, you don't currently have shares to give somebody. Here's what happened with DRNA. We called the short right here, not giving it enough time for expiration, only 35 days, and you can see it just went straight sideways. We're going to double down right here in anticipation that the trade will still work out. But to the next possibility of being assigned, the position is at expiration. There's 3 possibilities at expiration. The stock price will be at or below the lower strike that we sold. If this happens, then the calls of the bear call spread expire worthless and no stock position is created. If the stock price is above the lower strike price, but not above the higher strike price, then the short calls are assigned and the short stock position is created, which is what happened to me here. I needed price to stay below this line, and it went perfectly sideways. If the stock goes above the higher strike price, then the short call is assigned and the long call is exercised, meaning the stock is sold at the lower strike price and purchased at the higher strike price, resulting in no stock position. So one more visual: if we sell the 35 calls and buy the $40 calls for protection, creating a break even, we want price to stay under that break even. This will capture our full amount of profits. Next is, if price really shoots above this higher strike price, they will buy the stock position here, which will cover the stock position down here, washing it out. As we can see, price just kind of went sideways, staying above the break even line, and that's why I was assigned these shares. So now what? Let's look. Currently, the stock is higher. Here's my trade price, and since I'm negative in my shares, I want this price to go down, which is nice because today's Monday, and you can see we're negative, not by very much. But what if we would have opened up 3% down today? That would have made profit for me because I'm negative in my shares. And that little move down today gave me $75, making me 8% down in total ROI. And here's the total amount of value that I'm down. But I'm not really. See this $225? I've never been in this trade before, so I haven't really lost. So all I'm going to do is click on it, create a closing order, and I'm going to go a little bit lower because this will give me more profit than where I am right now. So I made it for 10 cents less, limit order, good till cancel, confirm, and let it do what it does. Another trade that I was assigned is AGEN, 2,500 shares. This one's a little bit different, so let me tell you exactly what happened. We called the alert right here and didn't get in. You can see that price came down, then came up, and I was saying this is why you might want to take off good till cancels, watch the video, because it didn't give us enough time until expiration. If we wanted to do this trade, we should have rolled it out to an August. And this trade's a little bit different because it's up 1.5% today. And remember, I'm in shorted shares, so I need price to go down to make money, and instead it's going up, taking money away. Now, we're going to come in and we're going to double down on this position right here for an August expiration, but right now I need to deal with this trade. In our review video, we showed the results of July, and this was up 10%. So that was a risk that we took instead of closing out for 10% profit, seeing if we would be assigned or not, and we were, because today we're down $225, which again, I've never been in this trade before. We're still up $50 for the whole entire trade, but we would have been up $275 if we would have closed out the other day. So all we do is come up, create our closing order. I'm going to put it at 545 to give me a little bit of money, and limit good till cancel, and of course confirm. This is a paper trading account, and so it has plenty of money to cover the negative shares that we're holding or any other margin requirements. If your account does not have the extra capital, this number will be negative and you won't be able to place any other trades until you close it out. And that's a brief overview of being assigned, the pitfalls, and what to do.